Okay? Forex is a place where you have to understand that this is business, okay? Because it's money related. So this simple strategy I'm going to teach you guys tonight, I need you to make sure that after learning, you go and practice it. All right. I sent the link also to the general channel so we can have some of our awesome traders, though not premium students, but I just gave it out free. So everybody should feel free to join and learn something tonight. Okay. So we're going to be more in the class tonight, but I just want everybody, as you join, please make sure that your mics are turned off. Okay. Make sure your mics are turned off so that there wouldn't be a distraction. All I just need is your ear and see everything that I'll be showing you right on the charts and gain the understanding and the wisdom. And don't worry, every single thing is being recorded, and I'll make sure that I post it out for you guys on YouTube after the training session so that you can always make a recap and learn better. So without further being said, let's dive straight into the charts. So instead of turning on your mics, please kindly use your chat box, okay? So if you can see my screen, please use your chat box and comment yes. If you can see my screen, please use your chat box and comment yes. Very well, very well. So let's proceed. So traders, I've taught you guys about psychological levels. And if you remember very well, there were ways I showed you guys for you to be able to plot out your psychological levels. And I told you that psychological levels are very important levels in the markets. All right. These are levels where we suppose that money is being loaded. All right. If you remember when I taught you divergence, I told you guys that divergence simply tells you that money that has been loaded is being exhausted. All right. And that's why it causes divergence. So this is for you to understand that there are zones whereby money are being loaded in the market. All right. So these high institutions don't just come into the chart and load money anywhere. No, they make sure they load money at psychological levels. They load money at specific zones where they believe that this is how this is the highest price has gone, and I believe that if I load money here, it should push market down to a lowest part. All right, and if they come to the if the bears come show up, they believe that by the time the if the bulls come, they believe that by the time they load money on the lowest low, it's going to take price all the way high to a certain level. So for instance, when you go to the market, okay, you don't want to buy things at random prices like you pricing things at 1000.2 or 1000.4. All right, you always want to make sure you're pricing things on whole numbers like 1000 or 800 or 500 whole numbers, right? So this is the same way it is on the forex chart, that when traders come into the market, when the high institutions and the big boys enter the market, they load money at random prices. Okay, now we've got to understand that the numbers you see here on your charts, these are what we call prices. All right, these are prices. So you need to understand that it's not just a digit, it's price. So when the high institutions enter the markets, they don't just load money on anyhow price, they load money at specific zones. And by the time we begin to plot it out, you'll be able to see it and even understand it better. Okay, now if you want to plot out your psychological levels, you can go straight to the 4-hour time frame. All right, currently, as you can see, the market is not moving because it's weekend. For all those who are in my class who are learning the currency pair, you understand what that means. All sessions are closed for the weekend, so nothing is moving. apart from, you might likely see BTC moving gradually, but not with full force. Okay, so if you are on your 4-hour time frame, probably what you want to do is you want to plot out your support and resistance. Okay, you want to plot out your support and resistance. Already I've got all those lines here. Let me just unhide it. But I'm going to show you exactly how you can be able to put all these psychological levels intact. Okay, now on your 4-hour chart, what you want to see is the trend. Where is market heading to? So that by the time you begin your processes, you know what you're looking out for. If you're looking out for buys, or if you're looking out for what? Sells. Okay, so from the 4-hour chart, we can see clearly that our bias is what? Bearish in this market, the GBP card. So we be looking out for selling opportunities more in this market. All right, so after you've seen what the trend is, now the next thing is what? You want to begin to bring out your psychological levels. So with my proper research and back testing, I've got to see that these psychological levels are very interesting when you spot them out on your entry time frame. Okay, that's just what I noticed lately. It gets more interesting because on the norms, I usually bring them out from 4-hour and 1-hour time frame in order for me to have a cleaner chart. But I just noticed of recent that it's even much interesting when you have these levels on spotted out on 15-minute time frame. But the secret about it is that you're not going to make it cluster. Rather, you're going to give it a 50 pip space. Okay, you're going to give it a 50 pip word space. So let me just show you exactly how to do that. You go straight to your 15-minute time frame. Already we know the bias is bearish, so we're looking out for selling opportunities. Then we're going to put it like this. Now you can see clearly already that I've got all the psychological levels, but I'm going to clean it and begin to draw it out again so you see how to do that. But I just want to show you that each of the psychological levels are worth 50 pips. All right, each of the psychological levels here are worth 50 pips. 50 pips. All right, each of them are worth 50 pips. So that is to let you, so that's going to enable you have proper space to be able to arrange your setup. Okay, so you don't want to have your chart to be so soiled up. So already from here to here, I can have enough space to look out for my entries if I want to take entries. Okay, now but you can actually do the same thing from your 4-hour or 1-hour. It's not a big deal, but it's easier. Okay, it's easier if you're on the 15-minute time frame or your entry time frame anyway. So how do you bring out this psychological levels? Now let me just delete every single thing that I analyzed so far, and then I want to start bringing them out one after the other. So first thing you want to observe is where is price currently? And here, this is where price is currently, all right? So you want to zoom in like this probably. All right, so you can see clearly this is where price is currently. So if you want to bring out your psychological level, you might likely not want to waste your time putting so much levels. You just want to focus on maybe from here, all right, to here, the lowest low, all right? Or maybe you want to take it even a bit lower. So that's going to be that for that. So let's start bringing out these levels. Now, this is a random number, all right? But we don't want random number. We want whole numbers, okay? This is 1.614886 is a random number. We want whole numbers because in whole number is where these high institutions load their money. So what we're going to do right now is we're going to start with 1.62 thousand. And then we'll bring out another. We're going to make it 1.615. we bring out another, and we can give it 1.61 thousand. Let's be sure that this is 50 pips. Okay, is 50 pips. Is 50 pips. Okay, so the next is going to be words. Use your chat box. I want to make sure that everybody's understanding what I'm elucidating here tonight. From after 1.61 thousand, what's going to be the next? Use your chat box. Let me be sure that you understand what I'm doing, traders. 1.1 thousand, what's going to be the next? What's going to be the next? Type it out on your chat box. We are working in 500s. All right. So what's going to be the next? We are working in whole numbers of 500. After 1.61 thousand, what should be the next? 1.6500. All right, just keep typing out the numbers for me. Keep typing out the numbers. What's gonna be the next? What's next? What's next? Talk to me, traders. I want to just be sure that you all understand it. 1.6 thousand. Next. Just keep typing it out. Keep typing it out. Okay. 1.55. Good. So that's to be sure that you all understand what I'm teaching tonight, so that you can understand how to bring out your psychological levels when you on your own. Okay. So it should be 1.5 thousand. One point 6 thousand, 1.5 thousand. Let's see, 5,000. Where the heck is it going to? It's going below. Okay. Okay. It's going below. We're gonna bring out 1.5500. Just hope we get it. It's still going below. Still going below. Okay. I know what we're gonna do. We'll bring out 1.59500. All right. Next is going to be 1.5 900. Okay. Next is going to be words. 5.5 words. 85. One more. Next is going to be what? 1.5 800. Good. All right. So I think this needs to be shifted to 1.7,000. Okay, 1.7500. Okay, and that's gonna be enough for now. All right. So once you're done doing that, you want to observe if all of them are accurate. Okay, just want to make sure 50 pips. 50 pips. All right. 50 pips, just close to it. What is the same 50 pips? Okay, 50 pips. All right, so every single thing here that we've just plotted out is what 50 pips worth. Then the next thing you want to do is to bring it all out like this. Just normalize your charts. Good. So once your chart is set to normal, so once your chart is set to normal, let us now observe how price plays at these psychological levels. Now we can see clearly that when price got here in the past, what happened? There was reaction at psychological level of 159,500. All right. Around the same zone, a psychological level, price played a role. Same thing around the zone, price played around. Same thing here, price played around. Okay, let's just keep observing price and its reaction in psychological levels. You can see here. All right, you can see here. You can see the reactions around all these zones. You can see reactions around all these zones, right? You can see reactions. You can see reactions. You can see reactions at psychological levels. Okay, so price plays a very big role whenever it gets to psychological levels. Why? Because these are the zones where the higher institutions are loading money from. You want to understand that every single move the candle makes on the chart is moved because of money. It could be high money, it could be low money. But instead of saying it like a like a layman, okay, low money, high money, you rather say high liquidity and low liquidity. Okay, you can see psychological levels and how price plays around, just like money is just being loaded to move 50 pips each, right? You can see how price keeps reacting at psychological levels. So when you have psychological levels, you might rather not even need to stress yourself out plotting out support and resistance at times, but there are times when you really need support and resistance. It all depends on the particular market you're looking out for though. Okay, so you can see how price plays around at psychological levels. I think that's quite enough. Everybody should have understood the logic behind that now. So the next question is, how now can you take advantage of psychological levels? All right. But before I proceed, I want to make sure that everybody understand how we plotted out all these things. So if you understand, comment, I understand. If you understand how we've just plotted out all the psychological levels, comment, I understand. I just want to make sure that you all are grabbing the knowledge. All right. Just comment, let me be sure. Comment, I understand. Very well. Very well. Okay. Now that we have just played out psychological levels and we understand the logic behind it, what's the logic behind it? The logic behind psychological level is that money is loaded in the market from that zone. So when you have your psychological levels all spotted out in place, at the back of your mind should be that this zone means money was loaded here, right? And as a trader, you want to trade along with the trend. You want to trade along with those who are currently in power because you don't want to trade against them. You should know very well as a retail trader that your money cannot move the charts. Your money can't even move a single candlestick on the charts. So these candlesticks are only moved by huge amount of liquidity. When they tell you that the amount of $7 trillion flows in the Forex markets daily, you should understand what that means and the amount of money that people use to move candlesticks on the chart. So as a retail trader, have it at the back of your mind that you cannot move a single candle on the charts. You know, when I used to, when I was about starting trading those in the previous years when I started, I used to think that we can actually move this chart, you know, because what I used to say to myself then is, oh, it's going down, it's going down. Let me sell, let me sell. Let everybody in the world also be selling. It's going to go down, you know. When we join different platforms where they say everybody buy, you know, at the back of my mind, I'll just be like, oh, since all of us are buying together, it means this market is going to go bullish, only for us to see market go bearish. You understand? And it could be it could be quite funny, but that's the mentality of a lot of traders that makes them sometimes lose money in the market. They just feel like if I'm selling, and probably many other people are selling together, is going to move the market selling. No, it doesn't move like that. The candlesticks move based on the huge amount of liquidity or money that have been loaded by high institutions. So what you want to do as a trader is to buy when high institutions are buying, and you sell when high institutions are selling. In that way, you can be able to make profits. Because if you sell when they are buying, they're going to crush your later account. Okay? So, but these high institutions do not love it when you buy with them. They love it when you sell and they're buying, because they know that's the only way they're going to smash your money off their accounts. You understand? So you have to be smart in this market. You don't have to come into the market without having the knowledge of it. That's why I said, if you don't have a strategy, it's not advisable that you trade the market. You have to trade the market when you know you have a strategy that's working for you. All right. So these high institutions, they don't want you to buy with them. That is why they wouldn't want you to know where they're loading money from. But now with the knowledge, all right, we understand this logic. Okay. So now that you understand the logic behind psychological levels, how now do you trade along with it? For instance, we can see clearly that whenever price gets to psychological levels, there's usually a reaction, and that reaction can actually create a U-turn back to the previous side, or it can, after reactions, it can continue to the downside, depending on how market is moving. And do not forget your bias. Okay, our bias here is selling, so we're only looking out for what? Selling opportunities. So in the as we are looking out for selling opportunities, and already we know our psychological levels, what we want to do is we want to look for selling opportunities when price gets to our psychological levels. All right. But now you're going to notice something. You're going to notice that sometimes when price gets to the psychological level, there's a kind of trick it plays on people. You can see some tricks like this. You see how price came to the side, and what it broke out a little bit, came back down, came to psychological level here about 50 pips away, broke out, round back in, came here, broke out, round back in. All right. When it round back in, it broke out, round back up again, came all the way down, broke out here again, broke out here, broke out. You understand? And this is what they keep doing at psychological levels. So this for you to know that the higher institutions, they already know that people who know their rules of loading money. Okay. But they're not going to be as perfect as coming in like this and hit all back like this. They wouldn't be as perfect as doing this for you, because they know very well that if they move markets like this, you are going to make all the whole money off them, because you know for sure that because already you know their psychological levels and you know how to smash it. Okay, so that is why you will see them wanting to do things like this. They would come from here, and instead of them to give you a U-turn from here, they're gonna just move in a little bit, come back up, hit here, go here. Instead of giving you a U-turn from here, they will go a little bit up and come back, so that these psychological levels will begin to get you confused. This is what they keep doing. But now, as a trader, how can you wisen up and be able to get these people on their own trap? Now, that's where the logic of the strategy comes in, and I need you to pay proper attention. Okay. Now, with my experience and back test and research, this is what I found, that 70% of the times when price gives you all this rough move, 70%, I didn't say 80, I didn't say 90 or 100, I said 70%, or let me even say 60%, okay? 70% of the times when price do these rough things, okay, it does not move more than 20 to 30 pips away. What did I say? It doesn't move more than 20 to 30 pips away. What do I mean? I'll show you that. Watch out for this right now. You see, when price came here and broke out from here to here was about how many pips? 30 pips. When price came here and broke out from here to here was what? 17 pips. When price came here and faked out, was about how many pips? Just 10 pips. When it came here and faked out, how many pips? 27 pips. Now here was probably a normal move. It was about getting to the other psychological level, so you can count that, okay? But just keep observing some things. This fake out here was about what? 20 pips. So you must understand the difference between fake outs and non-fake outs, okay? All right, welcome back, everybody. So like as I was saying, you have got to understand the difference between fake outs and normal moves, okay? So from here to here was a normal move. Once it has crossed about 40 and going close to the 50 pips is a normal move, okay? So let's just keep observing. Let's keep observing. These were normal moves. These were normal moves. Okay, from here, let's see how many pips was this. From this breakout here to here was about 32 pips. From this breakout to here was about 24 pips. From the breakout here to here was about what? 9 pips. Let's just keep observing this thing. From the breakout to here was about what? 11, 12 pips. Okay. From the breakout here to here was about how many pips? 24 pips. From the breakout here to here was about how many pips? 24 pips. Now, you can see clearly that these fake outs are usually between 20 to 30 pips. All right. The fake outs that price creates against the 50 pip psychological levels are usually between 20 to 30 pips. All right. Anyone that goes beyond that is actually not a fake out, it's a normal move. Okay. So now you can see that logic. So number one, you have the idea of the psychological levels. Okay. And number two, you have now understood that those fake outs, okay, number two, you now understand that price would never go as perfect as this for you. It will never go as perfect as this for you, probably in a downtrend. It will never, all right? But rather, it will give you fake outs to fake you out quite a lot of times and hit out your stop losses. You understand? So now I've showed you the little secret of those fake outs that it does not exceed between 30 to 20 pips. Traders, give me just a minute. Again, I need to set up something. I'm having quite kind of technical interruptions here. Just give me a few minutes. Okay, well, welcome back again. Welcome back again. All right, so from where we stopped, so now that you have understood that simple logic, how now do you take advantage of these things? Now, this is where we talk about your key levels, okay? Number one, to use this strategy, you need what? Your psychological levels. You need your psychological levels, okay? And then the next thing is what? Your key levels. So For you to be able to draw out your key levels, you're going to put your square, your rectangle shape, I mean to say, from the psychological level all the way down to where the candle or the last candle ended, and you drag it to the future. All right. The idea is that whenever price gets back here in the nearest future, if it does not react here and go back, it might likely want to come back down, react here, and go back. Or if it breaks out of it, it might likely come back here and descend. So let's check out a few back tests of it. Here we have this level. We can see how price played. It came here, got here, and moved. All right. Here we have this level. When price came here and played about, this was about 40 pips above. When it broke back in, it gave a retest on that same zone and continued its move. In the same manner, price came here, gave this heat before it proceeded to the top. All right. In the same manner, price came here, gave those reactions, and proceeded. Even when it came back here, it tried to break out of the psychological level, got into it a bit, and came back down. All right. When price came here, to see the reactions price played around that key level. Okay, so this could be used as your key level where you want to look out for to take entries in the nearest future. Okay, in the nearest future, you can see price at reaction on the zones. So this is you having both psychological level plus key level as an advantage. All right, you want to have both your psychological level, this is so high, you want to have both your psychological level plus your key level as your multiple confluence to look for entries in the markets. Okay. We have price reacting on key levels. We have price reactions on key levels almost all the time. So now you have key levels, you have psychological level. What's the logic behind the key level? The key level is just there to let you know that, look, don't just rely on the straight line you're seeing here, but rather understand that price can easily hover around. Okay, don't just rely on price, don't just rely on this psychological line, but have it at the back of your mind that price in any way can move a bit higher and turn back. So if you have here as a key level, it should let you know that anytime you see price come back here in the nearest future, it's going to remind you that, look, don't just rely on this psychological line. Have it at the back of your mind that price can easily come into here and play around. So in this case, as a trader, when you want to take your entries, don't just wait, don't just smash the sell or the buy button the moment you see price as psychological line. Okay, you want to be patient. You want to be what? Patient. Let the candlestick that got to that psychological line, allow it to close and observe the next candlestick coming after it. Did you get me correctly? When the candlestick that gets to that psychological level gets to it, allow it to close and observe the next candlestick. Very, very crucial. So there's every tendency that candlestick that gets to that psychological level, all right, like this one, for instance, you could see when it got to psychological level, anyone who is impatient would probably smash a buy to buy because it was bullish initially. He might likely smash a buy only to have this candles do all these things to him. But if he was patient enough to allow this candle close, he would see that the next candle is below his psychological level. So in other words, you don't want to sell or buy, but you want to observe what's happening. Market was bullish, probably we were selling, we were buying. Suddenly price came to psychological level. On a norms, you should take that psychological level as an opportunity to buy again, having price create the next higher high, which obviously it did the same. It did it here, right? Created the higher highs, normal. But you don't know if it's really going to respect the psychological level or not. So rather, instead of you falling prey to it, what you want to do is to be patient and let the candlestick that got to psychological level close. So if you end up noticing that it did not that it closed below psychological level, then you want to be careful. All right, so let's get close to somewhere we have key levels so that we can take a little example from it. Now, for instance, let us take it as a typical example. Now, price rallied all the way down here, hit our psychological level. A trader who is not learned would, I'm coming, just want to hide something. Okay, good. Now, price came all the way from here and about 50 good pips, price got to psychological level. Now, a trader who is not learned would smash a buy instantly, believing the price would go up, only to have price go down. Now, why did he fall prey to this? He fell prey to it because he did not allow that candlestick that got to psychological level here to close. And if you notice, it ended up closing below psychological level. So if a candlestick closes below psychological level or your key level where you're looking out to buy, okay, if any candlestick closes below it, it tells you that it automatically tells you that you don't have a right to buy yet. You shouldn't buy yet because you don't know if this price might likely want to go back up and take here as resistance to sell downward even much more. So you don't want to fall prey to that. So in order for you not to fall prey, you want to allow that candlestick close, observe the next candlestick. Now the next candlestick probably might be bullish, and instead of it to break out of psychological level, it ended up closing below psychological level. This is to tell you that, look, it seems that the bulls are a bit weak here. The bulls are not strong enough to push price to the upside. So you've got to be careful. All right. Now, probably at the close of this candle, the next candlestick might even bring it lower and create this key level that ended here. So with your mind understanding what has happened here, you can use it to understand what will happen in the future. Now, in the future, you'll see candlestick coming down again, coming down again, coming down again. The candlestick that gets to psychological level, your mind should tell you, look, allow it to close. Now it closed like this. Let's say it closed like this below price. The next candlestick probably came down and suddenly went back up, closed above psychological level. If it closes above psychological level, right, you want to make sure you allow it to close so that you be sure that it closed above psychological level before you know if you should take the next candlestick. If the next candlestick that came was suddenly going down, you still want to be out of the market observing, because you don't know if it might likely go down. But even if it goes down, it might likely not go so deep. Since it has closed above psychological level, it simply means it might likely take it as support to rally back up. All right. So the idea is if you have a key level between here to here, all right, it simply means that you want to make sure that any entry you're taking, your stop loss would have to be here, below here. Okay. Any entry you're taking, make sure your stop loss is below this key level. So now this is for you to know that if the level is above 30 pips, if it's up to 40 pips and you know you can risk up to 40 pips, then it tells you that, look, this market is not good for you to take it unless you have other confluence that must have warranted you to look for an entry. If you don't have any confluence, any other confluence, or if probably this is the only strategy you're looking out for, okay, then I advise that you don't take this kind of trade, because the pips probably, let me see how many pips was this between here to here. It's about 19 pips. So it's good for you to actually take it. So if you could get it, anywhere around here, your stop loss 20 pips would be right below here. Or if you're willing to risk 30 pips, then 30 pips should be somewhere here, and it's safe for you to take it. Okay, so let's unhide the candles and see how price played. So right here, after price did what it did around here and shot back up inside, you could see that. Let me clean all these jargons. We just clear all these jargons so that we can see clearly. Okay, now you could see that the next candlestick that came back broke above psychological level. And now what happened? You will see that when it broke above psychological level, the best really tried to push back in, but they took that place now as support. Confluence is more confluence. Now you have three confluence: one, psychological level; two, key level; and three is a support to push price to the upside. And that was how price kept on moving to the upside. All right. Now let us take another example. When price came back here, you could see it was a very strong move. As a trader who is seeing this strong move, you should know that, nigga, you need to be out of the, you need to be careful with this, because it could keep moving deeper. You never can tell. So you want to make sure that you allow this candlestick close. Now it closed and closed below your psychological level. So you need to be careful. Okay, you need to be what? Careful. So if you're looking after for opportunities to buy this market, you want to make sure that the next candlestick should break out of psychological level. And obviously, this one broke out very far, all right, and then came back here. It simply means that it has left you. You don't want to stress yourself jumping into a moving train, because it's going to be difficult for you to find entries around here. So for this market to go as high as this, it has left you. So leave that market and look for another entry. And that is one of the reasons why a lot of traders lose money in the market, because they would see it and say, oh man, let me jump in. All right. Oh, let me jump in. And by the time they jump in, price rallied down a bit like this. Out of fear and tremble, they close and loss. So instead of you to fall to panic, I would rather advise you stay out of that market that has left you. Wait is going to come back to you again. All you want to do is to make sure you have your key level set up for the next entry. All right. So let me see another key level we have here. Okay. Now, and we had another example here. We saw price as price came forth around here. Price rallying to the downside, rallying to the downside. Okay. Now, price came here and closed. This candlestick closed here, but the next candlestick that came was what? Bearish. Also, it broke into psychological level, and the next one was bullish. All right. And I told you, you want to make sure that any candlestick that breaks in between psychological level, allow it to close. As long as it's still on your psychological level, is unpredictable. So this one broke up. You still want to make sure it closes before you look for an entry. This one came back down, broke in, playing around psychological levels. Then this one broke out. That was good. And then the next one came back down and the bulls pushed back. So you want to look for your entries around there. So now we can see another one we have here. All right, your key levels. So these key levels helps you to be able to know where you want to look out for your entries. All right. So with the help of psychological levels, you already know where price is heading to. That's just the main help of psychological level. You know that if I can catch this move, I know where price is going to. It's going to the next 50 pips. Though it's going to take time, though it's going to joke around, you know, it's not going to move so straight unless it's just once in a while you have price do things like what is that example we had before? What is that example? It's only once in a while you see price do all this kind of rough move. And these are caused by news. For those of you who are trading currency pairs, you understand what I mean when I say news. So it is rare for you to really see price move in that strong format. Okay, so many of the times we always see price play around with emotions, play around. Okay, price would always play around, but the fact is, with the help of psychological level, you know where price is going to. From your resistance, you know the next level, 50 pips. All right, from your support, you know the next level, 50 pips. Okay, so after you have psychological level, the next is you want to look out for all those zones where price faked out, all those price zones where price came in and ran back up. You want to mark it out as what? Your key level. If you remember the last video that I posted concerning volatility 75, where I told you guys about weak rejections, all right? These are still part of those things that causes those weak rejections. So you take these weak rejections as your areas and your zones where you want to mark out as key level to look out for entry whenever price gets to it in the nearest future. All right, so that's just a simple logic behind all these things. Now let's drag this from here. We can see how price kept reacting on this key level. Okay, see how price kept reacting on this key level. And the funny thing is that whenever it's reacting like this and going beyond key levels and going beyond psychological levels, it doesn't go beyond 30 to 30 pips. Okay, anyone that goes beyond 30 pips is not a fake out. It was a normal intentional move. Okay, so that's just the simple logic about using your psychological levels and mapping out your key levels in order for you to be able to trade against the market. All right. So I want to believe that everybody grabbed knowledge tonight, and you should be able to go practice this right on your chart and see if you can take it as a good strategy that can work out for you. All right. So if you really understood every single thing that I taught tonight, use your chat box and comment, I understood. Very well. Very well. Very well. So that's just what I needed to expose to you guys tonight so that you can be able to take advantage of it. I'll still make sure that I post it out on YouTube for you guys in case of those who just joined so that you can actually rewatch it and understand it well. Okay. Somebody said, what time frame do you use it? This is my 15-minute time frame. This is my entry time frame. So I use it on my entry time frame, 15 minutes. All right. I'm taking your questions, right? You keep posting your questions. I'm observing your questions, traders. If you have questions, just drop them on the chat. We have about 5 minutes more. I understand. Very well. Very well. Very well. So when running on your analysis, you might likely want to take psychological levels as is part of your strategy, okay? Because it helps you have an idea. How do we get our sniper entries? You get your sniper entries from your key levels. You have your key levels. You get your sniper entries from your key levels. That's why I said you want to make sure that you allow the candlestick to close. If you're looking forward to buying, make sure the candlestick closes above the psychological level. All right. Make sure it closes above your psychological level. We have this little example here. When price came faked out before, it went back in, and the same place it faked out again. Now look, when it rallied to the upside and closed, the next candlestick that came back about 50% of it. 50%. All right, this should be about 50% of this candle. Yeah, that was 50% of it. So from that 50%, you can likely use it to take your entry. And make sure that every single trade you take, you set a stop loss. We need to understand that when it comes to trading, your strategy is just about 20% of the game. Your strategy is about 20% of the game, while 60% goes for psychology, for your psychology as a trader, your emotions. All right. Then the remaining percentage, which is probably 40% or 20% more, is your, what do I call it? Is your risk management. I hope I got that correctly. 20% is your strategy. 40% is your risk management. All right. And then the remaining percentage is your psychology. So risk management is very crucial. I always tell my students that risk management is a strategy of its own that you must make sure you practice and learn. Do not take any trade without applying your stop losses, and make sure that before you take any trade, you should know how much that you're willing to lose that trade, so that when you take it and set your stop loss, behind the back of your mind, you know that if it goes against me, I'm just losing this amount. But you know what you are targeting. You are targeting about what? 40 to 50 pips and above. You want to make sure that you don't trade anything that is below what you're risking. If you're risking 20 pips, make sure you're targeting up to 40 pips and above. That's what we call 1 to 2 risk to reward. Do not use 20 pips stop loss to target 20 pips take profit. That makes no sense. Okay, make sure you're targeting higher. You're risking 20, you want to make 40. Okay, you're risking 20, you want to make 40. That's why I said when you see a trade that has gone and left you, don't chase it. Because if it has left you, it simply means what you're targeting from here might likely not even be up to 50 pips. Let's see, from here to here was about just 33 pips. And then probably you want to risk 20 pips. Okay, so you want to always wait for that candlestick to close, and so that you can see if the next candlestick that's going to come might likely go back down. So if it can go back down to about half of that previous candle, you can find your entry around here. Okay, set your stop loss 20 pips. You don't want to risk more than 20 pips. And from here to here, you're targeting what? About 45 pips, and that's a good risk to reward. So now you can see that your 20 pips is right below the key level, the psychological level, and your 20 pips is also below your key level. So even though if price decided that it wanted to maybe play around and probably go even lower again, it's not going to hit your stop loss, probably in my range, and play with your emotions, no problem, before it continues the move. So it is very important that you take entries at important zones. Take entries at psychological levels or key levels, so that your stop loss would be on a safer side. Okay. How did you draw the key levels? You're going to have to watch this video when I post it on YouTube. Probably you weren't with us when we started, so I can't go back to that because my time is currently up. I've got quite a lot of things to do tonight. That's why I decided to run this training earlier. Okay, so you're gonna watch the video when I post it on YouTube for you guys. All right. So one more question before I go. One more question.
Let me start in, please. What's the difference between the psychological levels and order blocks?
There are big difference.
Okay.
Psychological level is where institutions are loading money. That's a general thing. While order block is where maybe individuals, all right, not
Okay.
this in this case, it's not the institution. It is not I don't know. I don't really know how I'm going to put it to make you understand it clearly, but psychological levels happen quite just like we came into the chat right now and we're able to plot out psychological levels at 50 pips, all round figure, 50 pips. And we saw how a lot of them played, but you cannot calculate 50 pips for an order block. I don't know if you understand. You cannot calculate 50 pips for an order block because an order block can be created anywhere. But psychological levels have levels that once
specific
you set them,
zones.
Very well, specific zones. So in between the trade move from one psychological level to another, an order block can be created. In between psychological level to another, an order block can be created. That's just how it is.
Okay, thank you.
Very well. So traders, that's where we end our class tonight. And I'll make sure that I post it for you guys so that you can make sure you rewatch and learn how to plot out your psychological levels and take advantage of this wonderful strategy. You can actually use it even on your VIX. All right. You can also try it out on your boom and crash for those of you who love trading with a boom and crash. All right. So try it out any of the markets. All you just need to do is to make sure you're back tested and see if it's working more often, that you can actually take advantage of it. That's just how it works. So for the meantime, traders, I want you all to make sure that you stay safe and keep winning.
Thanks and good night.
Have a wonderful night, trader.